Welcome to Get Rich Education. I'm your host, Keith Weinhold. How can a 50% rate of return possibly be low risk? Then we're talking about how interest rates, inflation, and the Fed affect you as an everyday consumer and an investor with a great guest today on Get Rich Education. Finally, with Total Control Financial, get checkbook control of your existing 401k and IRA funds to invest in real estate. Yes, you can move your retirement money into your own checking account, but you must avoid the little-known tax that you'll get hammered with in a self-directed IRA. Instead, start your QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Jodhpur, India to Jasper, Indiana, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education, bringing you your necessary weekly breath of abundance oxygen, because the scarcity mentality is abundant and the abundance mentality is scarce. Chris Martenson returns to the show to chat with us in a few minutes here. I thought it was a good time to have him back because he's moving heavily into real estate right now. Understand that you can get a 50% rate of return with little risk when you strategically buy investment real estate. Now, that gives some people pause, because when they hear about a high-flying ROI like that, they think, oh, well, gosh, that must involve some inordinate risk, or you must have to be some sort of insider, or you're going to have to approach and take down some esoteric quantum computing algorithm. Well, none of those things are true. And it's refreshing that it's so clear once you understand this. Yes, we're talking about those 5 ways that you're paid in real estate investing when you're a direct owner in the property. In fact, you can understand this in less than 5 minutes. So let's review how this works. And then to bring a different angle to it, we're going to look at how changes in interest rates and inflation affect this return. So here we go. Say that you've carefully purchased a $100,000 rental single-family home where the monthly rent income exceeds the expenses. And yes, you can find these in the United States, Midwest, and South. Well, with your 20% down payment, that leaves you with an $80,000 loan. Your property is already occupied with a rent-paying tenant. Let's only look at what can happen after 1 year, just the first year here. Your first of up to 5 simultaneous profit centers is appreciation. Your property appreciates from $100,000 up to $106,000 in that first year. Of course, there are no guarantees here. This is just commensurate with real estate's historic appreciation rate of 6%. Now, here's the thing to understand. Your $6,000 gain is based on your down payment of only $20,000. That magic of leverage means that your return is 30% just from this first of 5 ways. And the uninitiated person might say, whoa, hold up. How did that happen? It's because you achieved a 6% return on both your $20K down payment, and you achieved a 6% return on the $80K that you borrowed from the bank. And by the way, the tenant is the one making that $80K mortgage payment for you. The second of 5 ways is cash flow. Let's cut this down so that it's only a small trickle of cash flow. Let's get conservative. Your rent income minus all the monthly expenses like mortgage, property tax, insurance, your property manager fees, who removes most of the hassle for you, your repair expense, your vacancy expense. Say this only leaves you with $100 of residual monthly income. Well, that's $1,200 annually, and it's still divided by your same $20,000 down payment. And by the way, this is the portion we call the cash-on-cash return. That's another 6%. Your third of 5 profit centers is loan paydown. Unlike your own home where you pay down your principal with money that you've earned from your own pocket, Like I mentioned earlier, your tenant pays the monthly principal portion of your $80,000 loan on this property, and at a 5% interest rate on a 30-year loan, that's $1,176 that the tenant pays down for you annually, divided by your same $20K of skin in the game again, means that that is another return for you, another 6%. The fourth of 5 ways is the tax benefit. We're talking about things like the mortgage interest deduction and something called depreciation that you can typically use as a tax write-off against your income. And this means that you often don't even pay tax on all of your rent income. As we know, real estate investors get all the tax breaks. Your return can be really hard to measure because it's based on your situation and some other complicated factors, but we'll conservatively call this investment tailwind another 5% for you. I know that's shooting low with things like bonus depreciation, but let's stay on the conservative side. And the fifth of 5 ways you can profit simultaneously is one that even some advanced investors don't consider. Just like inflation erodes the value of your lump of savings, it erodes the weight of your mortgage debt balance away just the same. So the $80K loan that you took out today has its drag diluted over time as more and more dollars circulate in an economy. It gets easier for you to pay that back. Inflation impoverishes the saver, but it enriches the debtor. We'll call this benefit a return of another 3%. Let's add up your returns from the 5 ways you're paid and come up with your total ROI then. We'll tally it up. That's 30% from leverage appreciation plus 6% from your cash flow, another 6% from your tenant paying down your principal, 5% from tax benefits, and 3% from inflation profiting. And yes, your year one return from this property is a whopping 50%. Now, yes, that is oversimplified. There's more nuance to it, but that's a quick review so that you have some understanding of the 5 simultaneous ways that you can be paid in real estate investing when you're a direct owner and you're not buying through a REIT or something else. But note that your return goes down over time, mostly due to accumulating equity. But if it's 50% in year 1, and then in year 2, it's 35%, and in year 3, it's 30%, you're doing really well. Now, of course, risk still exists, but even if one profit center or 2 profit centers get completely taken away, you've got 3 or 4 others. So invest in something that's both real and pays you multiple ways. Now, that was the most concise explanation you might ever hear anywhere on how and why real estate investors are the ones that get ahead. And that's very much the basis of what we do here at Get Rich Education. We talk about how to optimize those 5 ways. And by the way, if you're wondering, well, yeah, that sounds great, but where would I find the properties conducive to this that already have built-in property management? Frankly, you cannot find this in most U.S. places. You can find it at the same place where I buy my own properties for my own portfolio nationwide, and that is at greturnkey.com. Now, changes in interest rates and inflation affect most or all of these 5, so let's look at this. With the first one, appreciation, your property went from $100K up to $106K in our simple example. We call that appreciation, but on that 6% gain, really, 3% might have been from appreciation and 3% from inflation. The second way, cash flow, well, a lower interest rate is going to increase your cash flow, and higher inflation would also increase your cash flow because you could more likely get a rent increase while at the same time your mortgage payment is fixed. The third of 5 ways you're paid, loan amortization, that's obviously highly interest rate dependent. The lower the rate, the more of your tenant's payment goes toward principal paydown. The fourth of 5 ways you're paid, your tax benefit, that's probably the least affected by interest rates and inflation. And then the fifth of 5 ways you can be paid, inflation profiting, is obviously completely dependent on that rate of inflation. So those are the effects of interest rates and inflation on the 5. Again, if you seek real assets that have a chance of giving you those up to 5 ways you're paid, and you want to tie up some real rental properties that are even newly renovated properties, start at greturnkey.com. Now, understand that the U.S. Federal Open Market Committee, which we'll call the Fed, its 12 board members, currently led by Fed Chairman Jerome Powell, understand that the Fed controls interest rates, but inflation controls the Fed. Chris Martenson joins me as we talk about how the Fed manipulates and steers the economy that you live inside, and interest rates and inflation. WTF, what the Fed is going on here? You've probably heard of today's guest because he's a prominent author of books like Prosper and The Crash Course that have received plenty of acclaim and fame. A PhD, he is an economic researcher, writer, and trend forecaster interested in macro trends regarding what he calls the 3 E's, the economy, energy, and the environment. It's been 2 years since you were last here. Welcome back to Get Rich Education, Chris Martenson.
Thank you. It's a real pleasure to be back here today with you and all your listeners.
I've been with Chris in person a few times, and he really attracts quite a following. Chris, I think the average suburban Joe that maybe can look at something like usdebtclock.org and see that we have over $23 trillion in national debt, which is, by the way, $188,000 per taxpayer. And that sounds concerning. But, in a sense, I think that person says, so what? Here today, look at this economy. I got to raise up my stable job. And I can see that my company's stable because my company's profitable. My home is appreciated in value for, call it, 10 years now. My mutual funds are all up substantially. I see that the unemployment rate is low. In fact, I think one can make the case that we are in the longest period of peace and prosperity in human history. I keep hearing that the Fed is steering the economy, but so what? I don't see any problems with it. What would you have to say to that person?
I would say it's unfortunate that any of us have to get acquainted with things like monetary policy or macroeconomics, but it begins with this idea that you or I know and all your listeners know that our individual economy is related to how productive we are and the things that we do. So let's imagine, Keith, real quick, that you and I are each an economy. You've got a GDP, I've got one. We're each earning $100,000 a year, right? So we're good. Now, the way we measure these things, if we took a snapshot next year, well, you were boring. You just earned $100,000 next year. Your GDP grew by 0. You still went out the door every day, did whatever you do for work, brought in your $100,000, didn't grow. And so, boo, hiss, we frown at that. Meanwhile, I'm still earning the same $100,000 because I'm being productive, but I went out and I borrowed $100,000 to spend on a sports car. And the way we measure these things, my GDP just kicked butt. It went up 100%. I spent $200,000. Look at the growth. Yours was boring and flat at $100,000. And so what people need to be aware of is that a lot of what we're calling strong economic conditions right now, let's be honest, economic growth is pretty weak, but all the other things you mentioned seem pretty good, right? Well, that's coming with the government deficit spending at about a little over 6% of GDP, with private individuals going way into debt, but not nearly as fast as corporations. So we're having this huge debt-fueled party. And when we even take that snapshot, do we see 100% rates of GDP growth? No, we're seeing 2%. It's really anemic. And that's the worry here, is that what we're doing is borrowing more and more to keep up the appearance of economic growth. But underneath, are we seeing that real economic growth that you and I and that average Joe you just talked about? What do we care about? Well, I care about that your business is healthy. You care about that my business is healthy, which is ultimately, what are you doing that's productively increasing the wealth of yourself and thereby the nation? That's what we should care about. And that's what's masked by all that borrowing.
True growth isn't there unless there's some underlying productivity. And I think that's what you're telling us. But for a long time, the Fed keeps kicking the can down the road by printing more dollars and basically paving the world over with dollars and making problems go away. Why can't that just continue?
Well, that's a really fair question, and it's gone on for closing in on 50 years now since the abandonment of the gold standard. And so the idea is, well, we've gotten away with this for 50 years. Why not forever? The answer to that is that ultimately we have to go back to a really foundational idea, which is that what is money? If I have $100 in my pocket, what is it really? It's a piece of paper. Let's be clear. But it's a piece of paper with a strong agreement between all of us. And it has value to me because I can walk down to the store and buy things with it. Otherwise, it would just be a piece of paper. So money is a claim on the stuff I want, right? It's a claim on being able to pay my taxes. It's a claim on being able to buy food at the store or pay for a car or vacation, whatever. Well, then what's debt? Well, debt's actually a claim on future money. So if I owe $100,000 on a mortgage, I don't owe that today. I owe it at some point in the future. So when we look at the accumulation of debt, there's really fundamentally nothing wrong with debt. Although if we be a little careful and say, well, there's stupid debt, right? Borrowing on my credit card to lose it at the blackjack table might be dumb. And then there's productive debt where I go out and I'm buying to get a cash flowing property or expand my business. That's different. But within that, if we just said, look, we have to understand there needs to be a relationship between how fast we're growing our debt and how fast our prospects, that our organic real growth and prospects are growing. And for those 50 years, we have been doing something that's a little suspect, and that is we've been growing our debts at twice the compounded rate of our underlying economy. The debts have been growing almost 9%. Economy over that time averaged on a nominal basis about 4.5%, almost 5%. But on a real basis, less than that. So we're growing our debts twice as fast. That's the system. That's the system. Everybody says, hey, Chris, why can't that continue forever? And it's simple as saying this. What if your credit card debt was growing by 10% a year, meaning it doubles every 7 years, and your income is growing at 5%, meaning it doubles every 14 years?
Right.
Can you see how that, that becomes a pretty obvious intuitively for everyone listening? I hope that eventually you have a math problem. And that's the answer, long-winded, is to say, why can't this go on forever? It's because it's a math problem.
Is the math problem based in the fact that since money's a proxy for value, money's just being created digitally without any underlying value? Therefore, what really is an answer? Should one go back to the gold standard so the dollars are tied to value? Would that anchor us back to something that's rational?
That would be one possible way. I would love it to be tied to something other than the whims of unelected and elected officials to sort of manufacture as much new money out of thin air as they want. That's been proven all through history, whether it was coin debasement or clipping, once upon a time, physical cash printing in another set of times, like we saw with the wheelbarrows full of money in Weimar, Germany, or today it's digital equivalent where clickety-click, billions get created instantly at keyboards. When we see humans have that power, that capability, they've invariably defaulted to, hey, let's just print a little more, or its equivalent today. So I would like to see it tied to something. A gold standard, we know it works. Sure, I'd be in favor of that. But if we could do it with an equivalent of a Bitcoin or some other thing where the number of units are somehow out of the control of the people who would like to just make them up out of thin air, that would be great. Because then you get a whole different set of conversations. Instead of saying, you know what, we're going to cut taxes and we'll fund some really expensive wars and we'll do all these other things too. It's a different conversation when the government has to come and say, geez, would you like to continue blowing up Afghanistan 19 years later? Or would you like to have a new bridge? We have to make a choice. We can't do both, right?
One's productive, one isn't.
Yep.
Well, let's talk about what the Fed has been doing as of late to steer the economy. Last year, we saw 3 quarter-point rate cuts, which in a sense is an unusual timing for such a thing because usually there are interest rate cuts to help stimulate an underperforming economy or perhaps pull us out of a recession, but that's not the condition that we're in. Some of these conventional indicators look still fairly good. So what's really going on here? Why are rates being cut and why is the Fed injecting all this liquidity into the system now, even though they're not calling it QE? What's going on? This appears to be panic behavior.
Well, it has nothing to do with the economy, although the Fed comes out and pretends it does. They always come out in their little press conferences in front of their congressional Senate testimony. They say, well, unemployment this and economic growth potential that. But the truth is they're doing this because they've tied themselves to financial asset performance. The stock and the bond markets have now become the policy tool of the Fed, and that's how they're conducting their policy at this point in time. And they hope that by wagging the tail of the dog, which is the stock and the bond markets, which is just financial indicators, which really ought to just be a derivative of the economy. Economy's doing great, the tail wags happily, and we see stocks and bonds go up. They're thinking they can go the other direction with that. And as long as they keep the tail wagging, the dog's going to be happy. That's what they're doing. They are desperately afraid of having the stock or the bond markets go in reverse because it's a domino effect. It might get out of control. They're not sure if they could stop the next crash when it happens. But really, instead of saying, gosh, I support the idea that the Fed shouldn't allow the markets to crash, because nobody wants that. We shouldn't even be in this position in the first place. We shouldn't be here where the Fed is now slavishly tied to making sure that stocks never go backwards or down ever again. Because that's a dangerous precedent. And the longer they do this, it's inevitable. It's nature. Things breathe in, things breathe out. Spring, then summer, then fall. Life, then death. So what they're trying to do is unnatural. And that's make sure that everything never breathes out again, only in. Everything must go up. My view, could be wrong, but I'm not confused, is that when that breaks, the longer they've maintained this illusion, the worse the break is going to be.
I think a lot of people would agree that interest rates are artificially low. Would you say that they're artificially low because of the Fed? And if they are, should they not intervene? And should the free market prevail? And then would interest rates be higher then? What are your thoughts?
Oh, absolutely. They're fictitiously and fraudulently set by the central banks. There's no bones about that. Nobody questions that. Nobody would ever, in their right mind, go to Germany and go to the government and say, I would like to pay you for the right to lend you money, which is what a negative interest rate is, right? Free markets would never arrive at that conclusion. So a negative interest rate is prima facie evidence of unnatural market for money. And so that's the biggest monkeying thing. It gets a little confused. Let me simplify. Money is a social agreement. It's all it is. It's a thing that's out there. It's a medium of exchange. It's not real wealth itself. It's a way to temporarily store wealth. It's a social agreement. So when the Fed and the other central banks are busy cramming interest rates to unnatural, below market levels, what they're really doing is they're monkeying with the prime social contract by which we all live. And how do you make a decision anymore? So quick example, regulatorily, like the FDIC sets this insurance policy that says every bank's equivalent. Any bank you're in, we don't care. You have $250,000 per account coverage on that bank. Well, great. Now all the banks are free to offer 0% interest rates, including, the super, very, very cautious, very sedate savings and loan up the street from you that only has 20% loan to value to ratios to people they know. Compared to the fly-by-night commercial bank with a $200 trillion derivative exposure. They both get to offer 0% because that's the price of money. That's what the Fed said. Where's the information in that? It should be that the ridiculous bank has to offer 8 or 9% and the other one gets to offer 0 because there's information in the price of money. That's what the Fed has done with the other central banks. They've destroyed the price information of money so far that to the point that there's a little over $13 trillion of negative yielding debt out there, which is a way of saying your money has less than no value. And we're going to prove that by giving you less of it back in the future if you give it to me today. How do you even make sense of that?
These distortions can warp the mind, and it's just not what most people are used to. Now, of course, we don't have negative interest rates in the United States yet. We do in Japan and some parts of Europe, but it's so counterintuitive. It's so upside down. When you're getting paid to borrow, and when you must pay to save, well, when you're getting paid to borrow, if you take out a $100,000 loan at a negative 1% interest rate, you wouldn't need to make any principal reductions and you would only owe $99K after 1 year. That's how negative interest rates work. I think one can make the case that we could be building a Fed-induced bubble because old-fashioned savers, people that are used to getting a real inflation-adjusted return on their savings, they need to find ways to make money. And for decades, old-fashioned savers have done what they were told was the right thing by saving money. And you can no longer do things like keep cash in money market funds. You can't ladder CDs like you used to, perhaps. Bond yields don't beat inflation either. So my point is the reason that this could be a Fed-induced bubble with long-term low interest rates is it takes savers and it makes those savers go and take risks and push up these prices.
Absolutely. So we're just getting into some of the ill effects of having bad prices for money. And one of them is you force yield-chasing behavior. So if you are somebody, let's even imagine you're a pension fund with financial fiduciary obligations to achieve a certain rate of return, and you're getting 2.5% or less on your U.S. Treasury obligations, all the way on down to something approaching 0. What do? How do you make up the rest when you have an 8.5% needed return, or you're that elderly couple in San Francisco that needs a return, and your money market is offering 0.25? So what do? Well, you have to chase yield, which is another way of saying you've got to go out and chase risk. But there's so many participants chasing risk that as of today, I believe we just hit the record where the spread between junk debt, this is the worst of the worst, triple C. This is your drunk uncle who's never paid you back asking for $50 kind of debt, right? That stuff is now trading with just a couple of percent VIG over and atop what we might see in a treasury. It's not, normally you would get 5, 6, 8, 10, 12% more than a safe investment. Now it's just 2%. It's ridiculous. And so what that means is for the amount of risk, those people or entities who are buying, chasing that yield and that junk debt, the amount of risk they're taking is not even remotely being rewarded with an appropriate level of return. So risk and return have been completely violated. 5,000 years of understanding of risk and return. That's what the Fed has been monkeying with, and they've really broken that. And I'm sure some of your listeners already know this. I mean, raise your hand out there if you know of a project that went off at a silly cap rate. Under 3%. I'm sure we've all heard of them, right? They're out there now because guess what? There's not just dumb, but desperate money out there, insurance funds that have to get something other than 1%. And that's their cost of capital too. So they're out there chasing deals at 3%. If that didn't make sense 10 years ago, 20, 30, 40, 80, 1,000, it probably doesn't make sense today, but that's what we're being asked to believe, that this time is different. 4 most dangerous words I know.
That's some great historical context. You're listening to Get Rich Education. Our guest is Chris Martenson. More when we come back. I'm your host, Keith Weinhold. Countless property investors get killed with maintenance costs, but that's far less likely when you buy brand new construction. Let me tell you about JWB Real Estate Capital in Jacksonville, Florida. They pioneered the build-to-rent model where you can invest in new construction, turnkey rental properties. That's why JWB was featured on the front page of the Wall Street Journal. To learn more and see inventory, go to newconstructionturnkey.com. The company that's provided our listeners with more loans than anyone is Ridge Lending Group, NMLS 42056. You can finance more than 10 single families up to 4plexes. Serving most U.S. states, their knowledge and experience leads to your financial freedom. They're number one in the investment space. Pre-qualify and then chat with President Chaley Ridge personally. Start on your next investment property loan right now at ridgelendinggroup.com.
This is Rich Dad, Poor Dad, author Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. And the reason I respect Keith, he's a very strong, smart, bright young man.
You're listening to the show that's created more financial freedom for busy people just like you than nearly any show in the world. This is Get Rich Education. I'm your host, Keith Weinhold. We're with Chris Martenson from Peak Prosperity. Check him out at peakprosperity.com. Chris, you didn't get us into this situation. The Fed did, so it might be hard to answer this, but what do you think the Fed should do? They're pumping liquidity into the system. They've cut interest rates now so that they're down to 1.75% on the upper bound of the Fed funds rate. So they still do have some ammunition there. What should they do short of restarting and tying currency to something like the gold standard again?
Well, they should stop monkeying in the markets. They should entirely get out of this ridiculous notion that it's their job to assure that stocks always go up or bonds, always go up too. It's absolutely a flawed notion, what they're doing. And let's be clear. I mean, there ought to be some congressional and Senate pushback at this point in time because, and there would be if they weren't such conflicted parties there who rely on banking money to get reelected. But let's be clear. The 99% has not been doing well in this story. The 1% has garnered almost all of the income gains for the past 45 years, and everybody else has been suffering. And that's not right. It's not good. And elected officials presumably are there to represent the majority, and they're not. They're clearly representing the minority in this story, which is the well-connected moneyed elite of Wall Street. So that's, the Fed, what do they need to do? They need to get out of being social engineers. They need to stop protecting their buddies on Wall Street. They need to start allowing the markets to operate as true independent markets again. And they need to stop intervening. And they won't because their egos are involved and they are setting us up for a pretty big crisis.
We're not even feigning independence anymore. I don't think. Trump oftentimes directs Jerome Powell at what he wants the Fed chairman, Jerome Powell, to do.
Well, he doesn't. And let's be clear, the Fed's not politically independent. It hasn't been for a long time. That's just complete sham. And as well, I think your listeners need to understand that listening to what Powell says is no longer useful. This is one of those times in life where you go, do I trust what somebody says or what they do? So, Powell came out and said things like, oh, rates aren't going to go up, or, we're about to wind down our balance sheet, or
Right.
we're not doing QE, or we're not targeting stocks prices. And it's ridiculous. The exact opposite of all those things is happening. So Powell, I want to like him. When I listen to him give press conferences, he seems more approachable and less opaque than his predecessors. So I like that. But he's a liar. And he's just been absolutely proven to have no integrity in this story. So fool me once, all of that. He's been fooling us time after time. So he's lost my vote of having appropriate integrity in this story, which just tells me, look, he's fighting some battles that he doesn't feel he can be honest about. And there's some things going on behind the scenes that they don't feel like they can tell us, probably because they don't want to spook the herd or whatever their rationale is. But let's be clear, the Fed has been operating in ways that are harmful to the majority of the country, certainly long-term, and have been very beneficial to a tiny elite. We'll call it the Davos set or whatever you want to call it. So that's what they've been doing, and that's anything but apolitical. I can't think of any more singularly political act than to reward one group of people and punish a different one. That's as political as it gets.
Yeah, Chris, you talk about Jerome Powell fooling us. Unlike Alan Greenspan, who was the Fed chairman from 1987 to 2006, Alan Greenspan, he would kind of have this Greenspan speak, and people were trying to parse the difference between the word moderate and modest that he used and trying to project what that means. Jerome Powell, I thought he was a fresh air when he was first our chairman because, for example, in 2018, he told us that in 2019 they're going to raise rates. So it looked like he was being transparent, but he was 100% wrong. They ended up lowering rates. They did exactly the opposite of what they said that they were going to do. But with all this Fed engineering and steering of the economy, where they seem to be doing more of this than they ever have, how bad could it get? Like, what's the worst place they could potentially lead us in the next 10 years or so?
Well, where this gets a little awkward is if it turns out all this debt has to go bad in some way. And, the Fed will fight it tooth and nail. They bought up bad mortgages in 2008, 9, and 10, and, they'll buy up treasuries that nobody else seems to want. They'll keep doing this for as long as they can. The longer they do it, though, Keith, the worse the imbalances get. And so John Stuart Mill said that panics don't destroy capital. They only reveal the extent to which it's already been hopelessly betrayed. And so that's the problem with money that's this cheap is that insurance company that bought that 500-unit complex with a cap rate of 2. There's nothing they can do about that purchase price after it's been done. That capital's been hopefully not hopelessly betrayed, but in many cases probably has been. We've seen a lot of the shale oil money is gone. Maybe his man is gone, and on and on and on. There's just a 1,000 examples. 1 in 8 companies right now is a zombie company, meaning that their operating cash flows are insufficient to even make the debt interest payments that they're carrying. So they need to tap credit markets to roll and stay alive. That's why they're called zombie companies. So we're watching that build and build and build and build. And so, do they stop when it's 1 in 4 companies that's a zombie? Is it 1 in 2? Do they stop when 5 people own as much as 90% of the world, or do they stop when 1 person owns the whole world? They've been unclear about when, where, and how they're willing to admit their policies are taking us further and further into these gaps that are really difficult to get out of once you get in them. Once you have a wealth gap like we've got into, what happens next, right? Do you get a Bernie Sanders or Elizabeth Warren who promises to forcibly rebalance that? Maybe, but first you should be asking, why did we allow that gap to happen in the first place? That's where the Fed, I think, has a lot to answer for here.
We are seeing a greater concentration of wealth. Tell us more about how bad it can get and how it would look for that everyday person, just like that average suburban Joe that I mentioned back at the beginning of the show that's got a stable job and has been getting raises and keeps getting new cars every 4 years.
First, we have to understand that what we're experiencing right now, again, we started in the first segment, we said, there's a difference between organic economic growth and credit-fueled apparent growth. In that organic growth, you have what's called a business cycle, and they breathe in, they breathe out. We used to have these very regular recessions, almost like clockwork, every 4 to 6 years. They would rinse themselves out like little brush fires in the forest. Credit cycles are different beasts. We had one in 2000, we had another one in 2008, and now we're in this third one. And here's the thing to the person you're inquiring about that they need to know. Credit cycles are a lot of fun on the way up. We get the new cars, we get the raises, everything feels good, but those things can go lights out really quick because the decision to either borrow and spend money or not borrow and spend money can be made in an hour. I can stop that process in 10 minutes if I want to. Whereas a business cycle, it's a little harder. They have a little sort of a longer latency to them. General Motors, like, geez, do we really want to shutter a plant? We've got all these union issues, and gosh, firing people so expensive. It's a different set of decisions. Whereas the CFO of GM can say, you know what, we're not buying any more stock back tonight, point, and it's over, right? So credit cycles tend to be over fast. And second, they tend to burst really hard and quick. So the impact for somebody, listen, most people, no matter how bad it gets, most people are going to keep their jobs, but not all of us will. And so for those who do lose their jobs, that's why we advise very strongly you need multiple streams of income, not just one paycheck. Have the paycheck, but also sell some stuff on eBay and have some cash flowing rental properties and figure out how to Uber if necessary, or whatever those other things are that you can do to begin to staple together multiple sources of income. That's what I'm doing right now. And I think everybody as well needs to protect themselves and have a little insurance, which is not be 100% invested in these markets. Don't have all your eggs, and God forbid, don't be leveraged long and have all your eggs entirely and more in this world that the Fed has created, because it's lights on, lights off is a very quick feature that we see. So it could get bad. I think to get right to the heart of it, this next crisis will be twice as bad as the one in 2008.
If you don't want to be a victim of the concentration of wealth, yeah, you said it, Chris, go ahead and develop multiple income streams if you want to continue to have a standard of living that's middle class or better. And, maybe someone asks why we're talking about this now. And I think it's important to remember that it's markets that are in a high place that can get toppled if they fall. If markets are at the bottom, well, they've got nowhere to fall. So it makes more sense to talk about this the higher that markets go. And you know what I say sometimes, Chris? Actually, it's not so bad being invested in a bubble. You might even want to be invested in a bubble, but you want to be out before the bubble bursts.
Well, absolutely. That's the hardest thing to do. Of course, timing, it's very hard to sell when you've got a lot of gains on the table. And it's even harder to buy when there's all sorts of blood in the streets. That, of course, gets right to the heart of investor psychology and your own personal investor psychology. I'm a big fan of when you have the gains, you take them, you lock them, and make sure that you know what your buy list is. So here's what I'm doing. I've actually built a lot of cash over these past half year or so. I like being in cash here. I'm happy to watch these bubble markets froth along. Other people can't miss out. It would kill them. That's fine. I'm built different. But I'm also developing my buy list, and I've just started to pull the trigger on some, for what for me is some really interesting real estate. So I'm going pretty heavy in that direction right now. And as well, we have this seminar we do once a year out in Sebastopol. This year it happens to be May 1st through 3rd. And we talk about our financial capital, really important. But as we talked a couple of years ago, we have these 7 other forms of capital: your social capital, emotional capital, some others. And we think having richness in each of those is what actually gives us resilience for the future and the ability to navigate any times that come, and also be happier and healthier today.
So a few takeaways there is to what an everyday person can do: have some cash, build multiple income streams, and have some real assets like real estate, something that can't as easily be debased with profligate monetary policy.
Absolutely. I'm more of a big, long swing trader, and I think this next decade or two is going to be some of the most fundamental revolutions we've ever seen. I think a lot of the things that we take for granted are going to be revealed to be false. Some new things are going to emerge. It's just a tremendous period of upheaval, and it's got a really big story baked in around where we really are in the energy story, where we really are in this credit cycle. Some things that are also happening on the environmental front, much less predictable. But oh my gosh, if you're in Australia right now, you're discovering that sometimes Mother Nature can be a really harsh mistress. And so that's really coming along in ways that are difficult to sort of get your head around. So what do? Well, as far as I'm concerned, you make sure that you do have hard assets, particularly land. I'm a big fan of land in this story. And I think people come to my site and read my most recent pieces, you'll find my larger thesis for why I think we're at the beginning of the largest back to the land movement in our history, way bigger than the hippies. They wanted to move back to the land. I think people are going to really begin to understand in a new way the importance of productive, hard assets.
Chris Martenson and his business partner, Adam Taggart, do a lot of forward-thinking things at Peak Prosperity, especially with respect to the economy, energy, and the environment. Chris, you mentioned your seminar earlier. How can someone learn more about what you're doing at Peak Prosperity?
Sure, just come on by the site. You'll be able to find it pretty easily. We've got banners up and running, and this seminar is going to be May 1st through 3rd out in Sebastopol. It's really nice out there in May. It's just beautiful. So if you're from New England like I am, it's a great getaway. And it sells out every year. So we're way ahead of last year's sales cycle. So if people want to get in, I'd really encourage them to come check that out. And the best part about the thing is that we get a bunch of people together who are able to think this way. They're curious. They're all very successful individuals. And you will be able to have conversations there that are really difficult to have elsewhere, potentially in your life.
Chris, tell someone more how they can learn more about you and what you're doing at Peak Prosperity.
Sure. Come on by peakprosperity.com. And if you look on that main webpage right now, on the front right there, you'll see featured discussion, and it says registration for our May seminar is now open. Just click on that. It'll bring you into a page, explain everything, and it'll get people right there. So love to see people. We'd love having new people come to this thing. It's just wonderful.
Having Chris and his knowledge in the room with you is really valuable. I would know. Chris Martenson, thanks so much for coming back onto the show.
Hey, my pleasure.
Yeah, great insight from Chris as usual. He points out that we've been growing our debts twice as fast as our economy, and it's going to result in a calamity worse than the last one because this isn't sustainable. And I don't think that Chris and Peak Prosperity are pessimists so much as they are realists. He's a rational realist. And Chris is one of those guys where I always learn something new when I've been around him, or I think about something I've thought about before, but I think about it in a different way. He and I largely had an economic chat today, but his work at Peak Prosperity really helps you understand wealth holistically. In fact, he might do holistic better than anyone out there. Now, you're here to listen to me to learn about things like real estate investing and wealth mindset and how economics relates to real estate and some other things. But Chris excels at articulating and really building a culture and a network around what he calls the 8 forms of capital. You have financial capital, social capital, material, living, emotional, knowledge, cultural, and then finally time capital. That's what I mean by holistic. In fact, Chris was last with us on Get Rich Education episode 175, where we discussed those 8 forms of capital in some detail. If Chris resonates with you, consider attending Peak Prosperity's 2020 seminar. Again, it's May 1st through 3rd in Sebastopol, California, which is north of San Francisco. Get started at peakprosperity.com. I will be in the United States for a little while longer before making a long trip to Singapore, India, Dubai, and some other places. And we've got a lot of great shows between now and then. I'm still going to bring you the show when I'm in Asia, in the Middle East. Yes, building your wealth never sleeps. Big thanks to Peak Prosperity's Chris Martenson today. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.